Guys, the Federal Reserve just signaled 3 more rate cuts in 2026, and when combined with what's happening in the private sector, we're looking at a potential transformation unlike anything we've seen since COVID. This isn't speculation, this isn't hype, this is a convergence of monetary policy, technological breakthroughs, and market dynamics that's about to reshape how wealth gets created over the next 12 months. And 90% of investors have absolutely no idea it's coming. So in today's video, we're going to break down exactly what you need to know and how you can use this to your advantage. Because there's going to be a lot of people that this becomes a shock for, people that are going to be left behind. And then there's going to be a lot of people that were prepared for this, people that are going to benefit massively. We're going to break all this down for you with the timestamps down below. And the only thing I ask in return for all the work that goes into making a video like this is that you hit this like button and don't forget to subscribe. Every time you do that, YouTube goes and it pushes this video out to more people, which helps us prepare more people for this incredible year. And if you want access to our full research and daily stock ideas, you can try our premium community for just $25 at stockscommunity.com. Plus, if you want to get the full transcript of this video and others like it, sign up for our free newsletter at free.stockscommunity.com in the description below. As always, if you're the one making the actual purchases, the sells, you have to do your own diligence as well. Take time, be cautious. This is not financial advice. I'm just sharing my research, and you have to make your own decisions. Now, let's get into it. Wall Street knows about this. The smart money is already positioning, and I'm going to show you the exact timeline, the waves that are coming, and why one specific company just achieved something this week that changes everything for investors. But here's the catch. The window closes fast, so let's break this down step by step. After a very choppy November and December, a lot of people are wondering what's next for 2026. Well, what does history say? December tends to be a big period of rebalancing volatility and some substantial chop, but also tends to end higher. The S&P 500 has finished higher 73% of all December since 1928. The strongest win rate of any month on the calendar. December isn't the highest returning month, but it does tend to be the most consistent green month. One of the big disadvantages we had this past year is that September, which is usually historically red, was actually a green month. So the fall sell-off got pushed to later, which is why we had such a choppy November. Either way, it's all opportunity. Instead of thinking you're damned if you do, you're damned if you don't, think it's all a win-win because you're looking at the bigger picture, and volatility is our friend, not an enemy. Now, over the last few months, we've been talking more and more about how important it is to consider what your account's going to look like over the next year and how to position yourself for the trends in 2026. My prediction for this year, and I want to say this as loud as possible, is that we're going to see an overall uptrending year thanks to the Federal Reserve cutting rates, unprecedented levels of CapEx, and of course, monetary expansion, which is going to all work together to cause a continued melt up. That said, and it's a big caveat, we're going to see massive volatility because of valuations, because of over leverage, and because of all the fear mongering that you get when multiples go into expansion cycles. All these are going to cause not just one of those April type crashes that we saw last year, but probably a lot more just like that. The data suggests this year is going to be an overall uptrend with a lot of big dips and a lot of conviction testing. That's going to be excellent for dip buyers and long-term investors. It's going to be great for traders that like both the upside and downside, but it's going to be a disaster for new people that just want to feel green every day. The minute you have 1 or 2 red days, these people panic. They bought high, they sold low. My mission is that you're not going to be one of these people. You're not going to fall for the media nonsense where they want you to buy high and sell low. You need to be somebody that thinks for yourself, looks at the evidence and data, and checks your conviction. You have to understand the bigger picture. It doesn't matter how long things drop, but are you positioning yourself appropriately for this year? That's what matters. Let's talk about what's actually happening with monetary policy, because this is critical to understanding where we're headed. After years of high interest rates crushing certain parts of the market, the Fed has shifted aggressively into cutting mode. Consensus is calling for 3 more cuts in 2026. The current Fed officials are trying to downplay this and say they'll only do 1 cut, but that's just not what markets think. And whoever the Fed chair is that gets appointed in May is going to push for more cuts. There's been open criticism about rates being too high. The target that's been mentioned has been around 1%. If we get even close to that, you won't even believe what kind of melt up we're going to be headed for. But why does this matter for stocks? Lower rates reduce borrowing costs for companies, makes it cheaper to finance growth, makes acquisitions easier and more common. Lower rates make stocks more attractive compared to bonds. When you can only get 3% from treasuries instead of 5%, growth stocks start looking a lot more appealing, especially if they can return 10 to 20% a year. And lower rates mean higher valuations are justified. When you discount future cash flows at a lower rate, present values go up. That's just how the math works. So something that you might say is really overvalued in a high interest rate environment could be fairly valued or even undervalued in a much lower interest rate environment. And consider that we just came off the highest, fastest rate cut in like 40 years. That can make a big difference. Let's talk about historical precedent, because this is important. We've seen this movie before. The 2017 tax cuts, what happened? The S&P rallied 28% in the next 18 months. The Bush tax cuts, small caps went up 47%. Real estate investment trusts went up 38%. If we go back to 1981, the Reagan era policies, the Dow went up a whopping 135% over the next 5 years. But here's the difference. The critical difference in 2026, we have record low unemployment. We have a Fed that's already cutting rates. We have pent-up demand in certain sectors. This isn't a recovery, it's rocket fuel on an already pretty hot economy. And if you go back to the COVID era, there were some clear parallels here. What happened to tech stocks after that stimulus? The most explosive rally in history. The NASDAQ surged 49% in 2020 alone, another 28% in 2021. That's 76% gains in the overall index in just 2 years. Apple was up 82%, Amazon 79%, certain EV companies up 394%. And the data that Wall Street doesn't want you to know, research shows that massive amounts of that money went directly into the stock market. Now, this isn't a coincidence. There's a direct causal link here. So think about that, and then think about what's coming. We're looking at a similar setup, but with different dynamics. Instead of government stimulus checks, we're looking at corporate spending waves. We're looking at rate cuts, making money cheaper. We're looking at technological breakthroughs that create entirely new markets. Now, speaking of volatility, let's talk about what we're seeing right now. The cryptocurrency market has been seeing massive deleveraging. Bitcoin is the usual bellwether. Bitcoin broke key levels of support. When it goes below those key levels, it tends to continue to consolidate. Over-leveraged players are getting washed out. There's record spot Bitcoin ETF outflows and broader risk-off sentiment hitting crypto. If you've been following crypto for years, you know this is just the game. Beautiful up cycles, beautiful down cycles. The people that get screwed are people that need things to go their way immediately. I'm a big believer in Bitcoin and major cryptocurrencies. However, it's very important to understand that whenever these go into bear markets, they can be very aggressive to the downside. That's actually a big opportunity for people that want to take advantage, not only to get good deals on dip buys, but also on the way down itself. That's why recently there have been opportunities in put options on certain plays, betting against some of the most leveraged Bitcoin positions. The reasons are clear. Leverage Magnification. When exposure is levered, downside stock waves hit way harder, high beta. Even modest drops produce oversized declines. Financing risk premium, debt-funded purchases create additional downside sensitivity. I want to be clear. Long-term outlook on quality assets is important. However, there's a massive place for benefiting from downside swings when they're obvious. Now, let's talk about what smart money is doing right now. This is where we are in the cycle. Defensive sectors are starting to weaken. Growth stocks and small caps are beginning to outperform. Volatility, the VIX, the fear index, it drops as uncertainty clears. In late 2016, before similar policy shifts came in, small caps went up 15%. Large caps only did 6%. The Russell outperformed the S&P by 9 percentage points in just 3 months. We're seeing similar setup patterns now. So where does money flow when rates drop and liquidity increases? Based on historical data, we can break this down. A significant portion goes to discretionary spending. Think consumer products, technology, electronics. Another portion goes to savings and investment accounts. What do retail investors buy when they open up brokerage accounts? They buy stocks, the popular ones, the names they know. Brokerage firms benefit massively. More money flowing into these platforms, and the stocks that retail investors buy, they tend to be the market leaders, the companies that are making headlines, the companies that are solving real problems. Here's where this gets really interesting for one specific situation. You have to understand that certain sectors are seeing unprecedented capital expenditure. We're talking about massive infrastructure spending, automation, AI development, and reshoring of supply chains. In 2017, when business investment grew just 6%, certain industrial stocks went up 34%. Now we're looking at potentially much larger capital flows into specific sectors. Goldman has projected over $1 trillion in spending from 2025 to 2027 in certain infrastructure categories. This spending is contributing more to GDP growth than traditional consumer spending in some analyses. We're talking about data centers, advanced manufacturing, energy infrastructure, and technology systems that didn't exist at scale 5 years ago. And executive orders have been signed to make it easier to build this infrastructure in the United States. This is a policy priority at the highest levels. What does this mean for investors? When the Fed prints money, when rates drop, when massive capital expenditure waves hit, the money doesn't flow equally to everyone. It flows to assets first. Stocks go up. Real estate goes up. Quality assets appreciate. The people who own assets see their net worth increase. The people who just hold cash in a savings account, they get left behind. And this is why being an investor in 2026 is so critical. The best way to protect yourself and come out ahead is to own quality assets. If you're just operating in the economy trying to make ends meet without any investment exposure, these policies work against you. But if you're in the investor class, if you own assets that benefit from these tailwinds, well, these policies might end up being incredibly favorable. The real measure of wealth transfer isn't what you pay for groceries, it's asset prices. And if quality assets go up 25%, that's 25% wealth creation in those holdings. Your salary didn't go up 25%, but people who own the right assets got 25% wealthier, which means if you're not positioned correctly, you're falling behind in relative terms. So what does that mean? Position yourself in quality assets. That's the logical conclusion. Now, could something go wrong? Absolutely. The Fed could change course. Inflation could spike, forcing rate hikes. Geopolitical events could disrupt markets. There are always risks. But if you look at the setup, if you look at the policy direction, if you look at where capital is flowing, the evidence suggests 2026 is setting up as a year where being positioned correctly matters more than almost any recent year. And that brings us to what happened this week, a specific development that I believe changes the entire calculus for one company and potentially for an entire sector. This is the kind of moment that happens maybe once every few years, where you can see the inflection point happening in real time. Okay, so here's the huge news that just dropped. A major company just achieved something this week that most people thought wouldn't happen until sometime later this year, or maybe even next year. They officially started offering their advanced service to the general public with zero human oversight. If you try to interface with the system, it literally tells you not to. Why is this massive? Let me state the obvious here. They've solved one of the hardest technological problems of our generation. There is no question about that at this point. It's literally only a matter of time now before this becomes the standard and a lot more value is unlocked. This puts massive pressure on competitors. Imagine how much pressure legacy players are going to be under to either develop their own version or partner with this company as it becomes common that this technology just works. People are no longer doing things the old way. The technology is doing it for them. It's like when a major tech shift happens. For a little while, people say, okay, we'll stick with the old way. But it becomes obvious quickly that you have to adapt. Not a lot of companies did at the time, but look where that left them. This is going to solidify even more dominance in this space. But what it also does is make it easier to launch in different markets. If they can say, look what we're doing here. We can do it in other places. That's a selling point. It's showing somebody something works versus telling them it's going to work. And that's exactly what just happened this week. This is a big value unlock for investors in this company. And as industry experts have put it, solving this problem is the holy grail of this technology sector. At the time, experts said there's basically nothing bigger than achieving this. And while other technological advances may be bigger long term, this is a close second. 50,000 people are affected by the old way of doing things every year. Did you know that you have significant odds of being impacted in your lifetime? The company that solves this is going to be rewarded handsomely. Another way to think about it, value is directly determined by how much you impact people's lives. The wealthiest people and companies aren't wealthy because they're evil. 9 times out of 10, it's because they did a lot for society. This is another big value creation for society. Major financial institutions were quick to comment on this. They say, removal of human oversight marks a pivotal moment in proving out this approach to the technology. The scaling of this system would seriously challenge the conventional thinking of many in this industry. Analysts expect significant progress in 2026, but even the bullish ones might not be bullish enough. Leadership of this company said this week that this service is going to be available to most of the population by the end of this year. Even the optimistic analyst projections are substantially lower than what leadership is suggesting. They're in for a big surprise. This is going to be the biggest driver of this company's stock in 2026. So I'm not surprised at all that the stock did well this week with all the positive news. In fact, I think it should have been up a lot more. And I do think further upside is likely in the cards. Videos started coming out this week. People were saying, I'm using this service without any human oversight. This is absolutely insane. Official statements came out saying that this service without any human oversight is now publicly available, starting with a few unsupervised units mixed in with the broader fleet, and the ratio will increase over time. In other words, they're saying that this technology is ready. Leadership came out and said, just started this service with no human oversight. Congrats to the team. If you're interested in solving real world problems with this technology, Tesla's the place to be. There's no human in the loop. This is what the market has been waiting for. This is what we want to see. This is such a big deal. And now here's why this matters even more than you think. Production of the next generation system starts in April. This means they can roll it out without having any human oversight requirement. They can now go directly from factory to deployment right away with nothing in between, which is absolutely massive. Another important thing, this took them 6 to 7 months to go from human oversight to no human oversight in the first market, but that was the first deployment. Other markets are next, and those deployments are going to take much shorter time for human oversight to be removed. If the first market took 6 to 7 months, other markets will take less than half that. This is a big deal because widespread deployment is much sooner than people think. And the crazy part is, this is where it gets really interesting for investors. Insurance companies are now coming out, and this is a huge signal. Insurance companies are saying they will reduce insurance rates if you use this technology. The insurance company is literally telling you that this technology is safer than the old way of doing things. So if you're using this technology, they will reduce the rate because the chances of negative outcomes are completely lower, absolutely lower. Warren Buffett came out years ago saying that if this technology becomes widespread, insurance companies are going to have to adjust their entire business model. These insurance companies currently operate on thin margins. How are they going to adapt? But the key point is, when insurance companies are coming out and saying this is massive validation. And on top of this, leadership make it very clear that pricing for this service will rise as capabilities improve. The massive value jump is when you can use the service completely hands off. We're going to see pricing go up significantly. Now there's mixed comments saying that increasing prices will reduce adoption. Okay, maybe now, but how about in 2 years, 3 years, when this becomes the standard way of doing things? When you don't really need the old way anymore. You just have this service and that's it. You don't have to worry about the old costs. You don't have to worry about actively managing the process. You have your time back. And if you're using the service, all you pay is the subscription price, which is 6 to 7 times cheaper than traditional alternatives, by the way. This company is not going to give mercy to competitors. They're going to increase pricing 100%. Now, here's the thing, guys. Some price targets by end of year are quite ambitious, but it seems like those might even be conservative the way things are going. Here's what I mean. They're rolling out the unsupervised technology. They're producing next generation systems in April. Widespread deployment seems likely by year end. Global expansion of supervised versions by year end. Subscription pricing to increase significantly. Things are aligning. We're at a point now where earnings might be lower this year than last year, but yet the stock could be higher. That tells you people are looking at future catalysts. If you can increase deployment in multiple markets, which they are, if you can show the numbers and projections, then investors will give this stock much higher multiples because we can see the future revenue coming. Deploy now, profits later. And Wall Street has said this out loud, and that's how they're valuing this company. They don't care about what this quarter is going to be. They care about what late 2026, 27, 28 is going to look like. That's what matters. If they only cared about current earnings, the stock would probably be less than half what it is now. But they see the potential. They see the value. This company creates a lot of it, and they see the high conviction that leadership and the community have. And they see this company is executing on what they said they would do. Unsupervised technology, no human oversight, it's here. And that's why it matters more than people think. Next generation systems on the way, directly from factory to deployment without any human oversight requirements. In other states and markets, the timeline is going to be accelerated dramatically. I need to tell you what company we're talking about here just to be super clear. This is critical. The company, and I already mentioned it, it's Tesla. They officially launched full self-driving unsupervised robotaxis for the general public in Austin. No safety monitors in the car. If you try to touch the wheel, it screams at you and says, do not touch the wheel. Tesla has solved full self-driving. They're now capable of unsupervised self-driving. The technology works. And insurance companies are literally offering to reduce your premiums if you use it. This is a massive validation. Lemonade and other insurance companies are coming out saying, we will reduce your insurance rates if you have self-driving. The insurance company is telling you that The software is a better driver than you and safer than you. Warren Buffett said years ago that if self-driving cars become a thing, insurance companies are going to take a big hit because they have to lower rates. These car insurance companies operate around 10% margins at the max. And don't forget, Tesla has their own insurance division growing state by state every year. But when insurance companies are validating this technology with rate reductions, this is massive. Elon made it very clear that the $99 a month for supervised full self-driving will rise as capabilities improve. The massive value jump is when you can be on your phone or sleeping for the entire ride. We're going to see this go to $149, then $199, and then once robotaxis are the majority of transportation, that could go to $299 or higher. There's mixed comments saying that increasing it will reduce adoption, maybe not in 2 years, probably not in 3 years when robotaxis are becoming standard. When you don't need to own a vehicle, you just have a robotaxi subscription. You don't have to worry about insurance. Well, if it's your own vehicle, you still have insurance, but because the car drives itself, insurance is going to be minimal. You don't have to worry about driving. You can do anything you want. You have your time back. If you're taking a robotaxi and not owning a vehicle, all you pay is the ride price, which is 6 to 7 times cheaper than Uber, by the way. Tesla is not going to give mercy to competitors. They're going to increase that $99 per month subscription 100%. Now, price targets by end of this year around $700 to $900 are being thrown around, but it seems like those might be conservative the way things are going. Tesla's rolling out unsupervised FSD. Tesla's producing cybercabs in April. Tesla robotaxis seem to be widespread in the US by year end. Tesla supervised FSD to be rolled out globally by year end. Tesla FSD subscription pricing to increase from $99 a month. Things are aligning. We're at a point now with Tesla where this year's earnings might be similar or lower than last year, but yet the stock is higher. That tells you people are looking at the catalysts. If you can increase robotaxi deployment in Austin, Bay Area, and other states and cities, which they are, if you can show the numbers and projections, then we will give the price to earnings of this stock way higher multiples because we can see the profits and revenue coming later. Deploy now, profits later. That's how Wall Street is valuing Tesla. They don't care about what this quarter is going to be. They care about what Q4 of 2026 and more importantly 27 and 28, how that's going to look with robotaxis and full self-driving. That's what matters. If they only cared about earnings, the stock would probably be less than half what it is right now, literally. But they see the potential. They see the value Elon brings. They see the high conviction that he has and the Tesla community has. And they see Tesla is executing on what they said. Unsupervised FSD, no monitors is here. Cybercabs on the way directly from factory to the road without any safety monitors. That means in other states, the timeline will be dramatically shorter. Let's talk about the risks because I want to be very clear about what you're taking on if you decide this is the right stock for you. First, execution risk. Tesla needs to scale this technology across multiple cities and states. Each jurisdiction has different regulations, different challenges. While they've proven it works in Austin, there's no guarantee the rollout will be smooth everywhere. Second, regulatory risk. Even though we're seeing positive signals from insurance companies and local governments, there could always be regulatory pushback if there's a high-profile incident involving an unsupervised vehicle. That could set back the program. Third, competition risk. Yes, Tesla's ahead now, but Waymo has been operating for years. Other companies are working on this. Chinese EV makers are advancing. Tesla's lead isn't guaranteed forever. Fourth, valuation risk. The stock is trading on future expectations, not current earnings. If Tesla doesn't meet aggressive timelines, if robotaxi adoption is slower than expected, if economics don't work out, the stock could see significant corrections. Fifth, broader market risk. If we go into a recession, if there's a major correction, if rates don't come down as expected, growth stocks like Tesla get hit hard regardless of fundamentals. And sixth, technology risk. While the technology seems to work, we're still in early stages of widespread deployment. There could be edge cases, situations that AI hasn't encountered, conditions that prove challenging. So you need to understand this is high risk, high reward. The upside is massive if things go right, but there are real risks. That said, I see a pretty compelling setup here. When you have insurance companies literally saying they'll reduce premiums for this technology, that's massive validations. When you have the technology working in the real world with no safety drivers, that's proof of concept. When you have a clear path to monetization through robotaxis and increasing subscription prices, that's a business model. The question is whether you believe in the execution, whether you believe in the timeline, and whether you're comfortable with the volatility. This is not a stock where you're going to feel green every day. This is going to be choppy. There will be big ups and big downs, but if you look at the bigger picture, if you look at what's being built, the opportunity is substantial. Now, what does this mean for your portfolio? That depends on your risk tolerance, your time horizon, and your conviction level. If you're a long-term investor who believes in autonomous technology, who believes Tesla is going to lead, then volatility is your friend. If you're a short-term trader, you need to be very careful about timing, position sizing, clear entry and exit points. This is not a stock you want to be over-leveraged in. But if you're doing the buys and sells, do your own due diligence as well. Look at the data, look at the evidence, check your conviction. Don't just follow what anyone says, including me. Make your own informed decisions. I think we're at a really interesting inflection point. The technology has been proven. The business model is becoming clear. The regulatory environment seems supportive. The economics are compelling with insurance reductions, lower costs than traditional alternatives, increasing subscription prices. But we're still early. We're still in the first innings. There's going to be volatility. There's going to be moments where you question your decisions. There's going to be news that drops the stock 10% in a day. There's going to be moments of euphoria where it rallies 20% in a week. The question is whether you can handle that volatility, whether you can stay focused on the bigger picture, whether you can avoid buying high and selling low, because that's what gets most people. They get in at the top when everyone's excited. They panic and sell at the bottom when everyone's scared. And then they watch it recover without them. Don't be that person. Be the person who thinks for themselves. Be the person who looks at the evidence. Be the person who has a plan and sticks to it. 2026 is setting up to be an incredible year for people who are prepared. We're going to see massive opportunities. We're going to see massive volatility, and we're going to see a separation between people who understand what's happening and people who are just along for the ride. The people who are going to win are the people who have done their research, who understand the risks, who have a plan, and who can execute even when things get choppy. The people who are going to lose are the people who chase momentum, who buy based on FOMO, who sell based on fear, and who let emotions drive decisions. Which one are you going to be? I know which one I'm choosing. I'm choosing to be informed. I'm choosing to be prepared. I'm choosing to take advantage of the opportunities that volatility presents. And I hope you're making the same choice, because the next 12 months are going to be wild. They're going to be full of opportunities, and they're going to reward the people who are prepared and punish the people who aren't. So make sure you're on the right side of that equation. Now, look, I'm not your financial advisor. I'm not a financial advisor. This isn't financial advice. You need to do your own research. You need to make your own decisions based on your own risk tolerance and financial situation. But if you're looking at the setup, if you're looking at what just happened this week, with unsupervised FSD launching, if you're looking at insurance companies validating the technology with premium reductions, if you're looking at the Fed cutting rates, making growth stocks more attractive, if you're looking at cyber cab production starting in April, this deserves serious attention. Smart money is positioning now in early 2026 before these catalysts fully play out. Don't be the person who watches from the sidelines while others capitalize on major shifts. And if you want access to our daily stock ideas, our analysis, and our full research, you can try our premium community for just $25 at stockscommunity.com. We break down setups like this every single weekday. Plus, if you want the full transcript of this video and others like it, sign up for our free newsletter at free.stockscommunity.com. The link is in the description below. So what are your thoughts on this? What are your favorite opportunities for 2026? What do you think about the unsupervised FSD launch? Let me know in the comments. I love hearing from you. But that caps off today's video. If you found this valuable, smash that like button, subscribe to the channel, share this with somebody who needs to hear it because the window is closing. The opportunity is now. And the people who position correctly are going to make life-changing returns in 2026.